Welcome, 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 and thank you for joining me for this weekly episode of the Market Whispers podcast. I am your host, Beachman, and I am super excited to have you here today. Today is Friday, April 5th. Now, right off the bat, I must clarify that I'm not a financial planner, and anything that you hear or read in this podcast is not financial advice. So please do your own due diligence and consult a licensed financial planner. And before I forget, please do me a favor and spread the word about this podcast and my newsletter. I keep the cost for my paid content very reasonable. It costs less than 3 lattes a month. My paid subscribers know the value that they get from my research, from my writings, from my market analysis, from the active chat line, and from this podcast. I have mentioned this before. I think I mentioned this last week, that coming soon is going to be my best sale of the year. I only put out this sale once a year in honor of Mother's Day. This is my best sale for the annual subscription package. So look for details about that in your inbox soon. And talking about paid content, just this week I started putting out to my paid subscribers my Beachman's AI investing tracker information. The post on that AI investing tracker is going to come out next week, but this week I started sharing with my paid subscribers some of the analysis that I've been doing along those lines. My goal has always been to identify the best AI investment opportunities, to identify those that are good, as well as to identify those that we need to avoid, to separate the wheat from the chaff. Now, why is this important? Well, just earlier this week, Goldman Sachs released some research that they did that showed that less than 5% of all companies around the world are actually formally using generative AI today to produce goods and services. So only 5% of companies are actually using generative AI today. Most of these companies are in the information and the technology space. So the broader business community has not really adopted and isn't really using AI today. We are in the very, very early innings of the AI revolution. Over the next 6 months, Goldman Sachs forecasts that the share of all companies using generative AI is going to increase only to about 7%. So we're really in very, very early innings. There's a lot of hype and froth right now in this space, and I'm trying to decipher through this hype and froth. I'm really trying to invest in the best AI companies by phase. Right now, many of the larger companies are spending billions of dollars of capex on building out AI cloud and AI infrastructure and AI data center footprints. So that's where the money is being made. Now that is going to shift into more AI software and AI data management work at some point in the future. And so my Beachman's AI investing tracker is going to help guide my investing approach and timing along these lines over the next 2 to 3 years. So please consider becoming a paid subscriber. Tell your friends and family about my podcast and my newsletter. I'd love to have them and you join the growing Beachman community. Now let's get into the meat of this episode. Let's start by reviewing the current state of the markets. Well, we finished off Q1 of 2024 last week. In Q1, the S&P 500 gained about 11%. This was one of the best Q1s for the index in recent history. The leading sectors in Q1 were communication services, companies like Meta and Google. They gained 16% as a sector. The energy sector gained 14%. Tech overall gained 13% in Q1, and financials logged on a 12% gain in Q1. The laggards in Q1 were real estate, which lost 1%. Utilities was another laggard, although it gained 5% in the quarter. The best performers in the S&P 500 index in Q1 were companies like Nvidia, Microsoft, Meta, Amazon, and Eli Lilly. The top 5 contributor stocks contributed about 31% of the gains for the index. The top 10 contributors, 10 stocks, contributed about 25% of the index's gains for the quarter. So the question on everybody's mind is, what does April have in store for the markets? Well, according to Argus Research, historically, April is the second best month of the year for stocks. The average gain for the S&P 500 index in the month of April since 1980 has been about 2%. Market returns in April have exceeded 5% on 8 occasions since 1980, including a 9.4% gain in 2009. That's when markets were recovering for the financial crisis of 2007. Markets gained 12.7% in 2020. That's when markets were recovering from the onset of the COVID-19 pandemic. And then the other big gain was a 5.1% gain in 21. That's when COVID-19 vaccines were being rolled out, and there was a lot of positive enthusiasm around the world about reopening. Now, there have also been some clunkers, some April clunkers in the S&P 500 index. In 2002, the index lost 6%. In 2000, it lost 3%. And April is typically a very busy month on Wall Street as companies start reporting first quarter results. We're expecting Q1 earnings to start coming out around the middle of April, around April 15th, starting with the large banks, followed by Tesla. Tesla always reports early, AMD. We've got some other consumer companies and materials companies that also report early. So Q1 earnings reports will start coming out in earnest around the second, third week of April, and then we'll get into the busy earnings season. So April is going to be a busy month for Wall Street. Investors will be focusing on technology companies again because they've been leading the rallies thus far this year in 2024. Interest rates will be another important topic for the month of April as markets start processing the latest readings relating to inflation. This week we got ISM readings for manufacturing and services. We'll talk about that in a few seconds. And we also got a big jobs report for the month of March. We'll talk about that as well. But next week, we will be getting an update on the CPI and PPI inflation indexes for the US. So markets will focus on that. Markets will also be focusing attention on the Fed's next meeting, which starts April 30th. Are they going to cut interest rates at all in the month of April, early May? Markets certainly right now believe that they're not going to cut interest rates. We saw how markets behaved yesterday on Thursday towards the close of trading. There were some Fed speeches given all this week, and in fact, yesterday there was a Federal Reserve Committee member that talked very bearishly about possibly deferring interest rate cuts towards the end of the year or not having them at all. Markets took that as a very negative sign and dropped significantly yesterday. So throughout the month of April, markets are going to be focused not much on earnings reports because those are coming out towards the end of the month, but they'll be focused more on some of these larger macro reports and macro updates that we're going to get. And as long as macro signals like labor, inflation, business optimism, consumer sentiment, etc., as long as these macro signals stay range-bound in the month of April, markets could stay positive for most of the month. So we'll see what actually happens as the month of April plays out. Let's shift our attention towards macro updates. Well, today we got the March jobs report for the US. Non-farm payroll jobs increased by over 300,000 in the month of March. Wall Street was expecting a gain of 200,000 jobs. Well, we got 1.5 times what Wall Street was expecting. So it was a very bullish labor report in terms of job creation. So in the month of March, over 300,000 jobs were created. In the month of February, over 270,000 jobs were created. The unemployment rate fell to 3.8% in March. It actually ticked a bit lower. In February, it was 3.9%, and now in March, it ticked down to 3.8%. When we look at some of the other details in the jobs report, inflationary pressures from labor rates continue to remain range-bound. Average hourly earnings increased by just about 0.3% year over year in the month of March, and that was in line with Wall Street's expectations. According to Fidelity Investments, the economy has remained resilient when it comes to the jobs market. It appears that the economy as a whole has become less interest rate sensitive today. That's because there's so much of labor demand um, in today's economy. There was a lot of excessive labor demand during the pandemic and shortly thereafter. And that labor demand went to such extremes that markets were flipping back and forth from bullish to bearish sentiment. Now, all of that has been remediated to a point where things have stabilized in the jobs market. The unemployment rate has stabilized. The number of job creation is pretty healthy. It's been over 200,000 jobs per month for several months now. And so we are definitely, according to Fidelity Investments, we seem to be heading towards the soft landing that the Feds are hoping that they can engineer. Earlier this month, we also got the ISM Manufacturing Index report. Now, I have said this before, the ISM reports are some of the leading macro indicators that I track very closely. The ISM Manufacturing report for the month of March came in, and manufacturing activity in the month of March increased slightly to over 50.3 points. Remember, an index above 50 means manufacturing is expanding, and it has been below 50 for many, many months now. In fact, in February, it was 47.8. So this is a flip from contraction of manufacturing activity into expansion now of manufacturing within the US. Now, we'll have to see whether this is a viable trend, but this is certainly a very encouraging sign. This was the first expansion in manufacturing since September 2022. New orders came in higher than expected. They moved into expansion territory as well. Productivity jumped 6.2 percentage points. That was another bullish sign in manufacturing. Input material prices rose slightly. Labor inputs slowed down slightly. And order backlogs dropped slightly. So overall, a very bullish ISM Manufacturing Index report. It indicates that the manufacturing sector expanded for the first time in 17 months, driven by improvements in new orders, in productivity, in input prices, etc., even while keeping labor and backlog forces in check. On Tuesday, actually it was on Wednesday, we got the ISM Services report for March of this year. The services index registered 51.4 points in the month of March. It's still in expansion territory. It's been in expansion territory now for 15 consecutive months. Services have been very, very strong in the US. Although the pace has been stagnating or slowing down a little bit, even as compared to February, it has slowed down a little bit in the month of March. And I think it continues to remain range bound. It has been range bound in the low 50s for 12 months now. Business activity in the services sector decreased, new orders decreased, employment expanded, and input prices expanded as well. So the ISM Services report is showing us that the services sector continues to expand, and it has been doing that now for 15 months or 17 months. The services sector in the U.S. continues to expand, but at a moderately slower price as compared to previous months. So there seems to be a little bit of a slowdown in services, and it continues to be range bound. We've been looking at commodity prices over the last week or so, and prices for several commodities have been rising slowly but steadily over the past few weeks. As per Bloomberg, we are at the end of an economic cycle and months away from some sort of landing. Whether it's a hard landing or soft landing, that we can debate all day till the cows come home. But we are tending towards some sort of landing, and at this point, we're at the end of an economic cycle. And according to Bloomberg, according to their research, usually at this time late in the economic cycle, two things tend to happen. Long-term interest rates start to climb, which we've seen in the markets. The 10-year and 30-year long-term interest rates have slowly been creeping up from the 3.9% to over 4%. So long-term interest rates start to climb late in an economic cycle. And the other thing that happens, according to Bloomberg, is commodity prices also start to rise. And that's also what we've been seeing in the markets over the last few weeks. Historically, commodities are best owned now because as we are late in the economic cycle and heading into a new economic expansion, which is expected towards the latter half of this year and 2025. As we head into a new economic cycle, demand for commodities start rising, and demand for commodities is typically more than the supply that's available. Inventories have been depleted by this time. Towards the late part of the economic cycle, commodity inventories are depleted because they aren't being ordered anymore. So inventories are down, demand starts rising, and supply stays anemic at this time in the economic cycle. And therefore, commodity prices start increasing. Commodity prices are also seen as a forward-looking indicator of inflation. Everything that we manufacture and utilize, almost everything, is derived from commodities. Now, I've always maintained that inflation is not going to get down to the 2%. It's going to be very, very difficult to bring inflation in the US down to the Fed's 2% target. We will continue to have inflation be range bound between 3 and 4% in the US. And consumers are, in fact, accepting that today, begrudgingly accepting that today. So as commodity prices stay elevated or even continue to rise further, inflation will stay range bound in 3 to 4% range. Crude oil this year has surged 24% year to date. Gasoline has risen 19% year to date. Gold reached an all-time high of 12% year to date this week. The Silver Trust, SLV, gained 14% year to date. And cocoa prices, we talked about cocoa prices last week. Cocoa prices have soared over 120% year to date. The commodities that haven't really moved up, wheat and corn. Wheat and corn are two important food-related commodities that haven't risen. They've decreased, in fact, between 7 to 8% year to date. I think that's good for us consumers in terms of food prices. So we'll take that. Now, the question for investors is this current commodity rally for real? Or is this another sign of the debatable market froth in today's conditions? The other question is it too early to buy in now, to buy commodities now with an eye to the 2025 economic expansion? These two questions are top of mind for me these days. This is exactly what I'm actively trying to figure out myself. I'm conducting analysis to decide what I want to do with commodities either this year in 2024 or in leading into 2025. And let's wrap up our review of macro signals by talking about housing. Housing has been showing a sign of potential recovery. Remember, this is one thing that I mentioned that could be bullish for markets as we head into the summer. Housing, if it starts showing good, solid, supportable signs of recovery, that could be bullish for markets in the summer. Now, the National Housing Market Index rose to 51 points in March. This was the fourth consecutive monthly increase. Again, readings above 50 depict expansion in that sector. They depict bullish home builder sentiment, and that's exactly what we got in the month of March. Now, this March reading of 51 was the first reading over 50 since July of last year. So it took us almost 9 to 10 months to get to a reading above 50. And this could be a viable change in trend. We'll have to see if that happens. Home builders are much more positive now about sales conditions, home sales conditions, and they have not been this positive for a long time, for over 12 to 15 months. They're also positive about current sales conditions as well as future sales conditions. Prospective buyer traffic is increasing as we get into spring and the onset of summer, and home building activity is also picking up. So some of this could be seasonal, as we get from winter into spring into summer. Some of this enthusiasm could be seasonal, and that's exactly what we'll be keeping an eye on to see whether it's a seasonal and a viable trend going forward, and how that's going to impact things like home builder activity, sales, consumer sentiment, market pricing, as well as the impact on commodities like lumber. So this again takes me back to my earlier question. What should investors do with respect to investing in commodities now, as well as leading into 2025? So more to come on that as I conduct my analysis, and I'll bring that to you guys in this podcast. Let's shift our attention now to interest rates. There seems to be growing pressure on the US Feds to start cutting interest rates. According to Bank of America, the Feds are starting to feel some real internal pressure to cut interest rates. And when I say internal, I mean pressure building up not only within the committee, but also within the US administration. Today, the US has paid about $1.1 trillion, trillion with a T. The US has paid more than $1.1 trillion in interest payments on US government debt over the past 12 months. These interest payments have more than doubled since the COVID pandemic, and they are set to rise by another $150 billion over the next 100 days. As long as interest rates stay elevated, these interest payments are going to continue to stay elevated and, in fact, increase over time. U.S. government spending over the last 5 months was about $2.7 trillion, and that's about up 9% year over year. And it's on course to reach about $6.7 trillion total for the fiscal year 2024. U.S. national debt is increasing by about $1 trillion every 100 days. And that is set to hit $35 trillion of U.S. national debt by May of 2024. By the time the U.S. elections comes around in November this year, U.S. national debt will be a whopping $37 trillion, and it's expected to reach $40 trillion by the second half of next year. So that's almost a doubling of U.S. national debt in the past 8 years. So the way to think about it is the U.S. Treasury, on a regular basis, it sells U.S. Treasury bonds to fund the operations of the government. So whatever the U.S. government has set as their budget in terms of what they're going to spend for the year, tax filings from U.S. citizens and U.S. consumers and U.S. residents, those tax filings fund a major portion of U.S. government operations. But the rest of those operations are funded when the U.S. Treasury sells U.S. Treasury bonds. As these bonds are sold to the market, the U.S. government has to pay interest on those bonds, right? So anybody that buys those treasuries, if you've bought U.S. treasuries, for example, or even if you've got money sitting in a bond fund, you are getting interest payments on that investment, and that interest is coming from the U.S. Treasury. So far this year, the U.S. Treasury has paid out $1.1 trillion in interest payments over the past 12 months. And this is clearly unsustainable, right? As interest rates stay elevated, these interest payments are going to stay elevated and continue to go up. And U.S. debt, in fact, is going to continue to go up because they've got to sell more debt in order to fund government operations as well as pay out these interest payments to investors. So this is the reason why the Feds are feeling some immense pressure and strong motivation to start cutting interest rates, to constrain the surge in interest costs, and to exercise what's being called interest cost control policy, or ICC. So the Feds are trying to find the right balance between cutting interest rates to stimulate growth, as well as keeping rates sufficiently restrictive enough to curb enthusiasm, as well as to curb interest expenses that the U.S. government has to bear as it sells bonds to fund its operations. So we'll continue to see what they do with interest rates. My theory is they're not going to start cutting interest rates until July of this year. Markets are not so sure we're getting a rate cut in May. Right now, markets are expecting the first rate cut to happen in June. But I think it's going to come more like in July. Shifting gears again, earlier this week on Wednesday, there was a 7.4, a very powerful 7.4 magnitude earthquake in Taiwan. This was Taiwan's worst earthquake over the past 25 years. The death toll, the last time I checked, the death toll from this earthquake has risen to about 10 people, and at least 1,000 people have been injured. In fact, rescuers are still searching for people that are missing or trapped in the rubble from buildings and houses that came down due to this earthquake. They continue to feel aftershocks of anywhere between 6.5 and 7.5 magnitude on the Richter scale. These aftershocks have continued for the past 2-3 days and are expected to continue for at least another 2 to 3 days. Now, Taiwan is a democratic self-ruled island just off the coast of China. China considers Taiwan to be a runaway province and claims it as its own. Free elections, China is a democratic self-ruled island. They just held free democratic elections in Taiwan. And the anti-Beijing faction retained the presidency. So the new president-elect of Taiwan is from the anti-Beijing party. However, in a really rare outcome, the legislature or the legal lawmaking body, the legislature was split into two factions. So both the anti-Beijing faction as well as the pro-Beijing faction won about an equivalent amount of seats in the legislature in this election. So the presidency plus the legislature is going to be a very interesting dynamic in terms of how they manage this country going forward. This region is one of the world's most dangerous flashpoints. So in the sea around Taiwan, so Taiwan's this island right off the coast of mainland China, but in that sea around and near Taiwan, you've got both U.S. and Chinese aircraft carriers and jet fighters within striking distance of each other. And add on top of that, you've got the defense forces of Taiwan itself. Now, the U.S. keeps aircraft carriers, strike groups with destroyers and other amphibious vehicles nearby to Taiwan. These are based in Japan, and they can get to Taiwan really quickly. There's about a 100-mile strait that's separating Taiwan and mainland, and Japan is fairly close by. So the U.S. can deploy defensive forces to Taiwan very quickly if required. They've also got bases nearby in the Philippines and in Guam. So effectively, the U.S. defense forces are close enough to Taiwan, and they really encircle Taiwan with battle-ready battalions if need be. And now China is also within a stone-throwing distance from Taiwan, right? I mean, you look across the bay from Taiwan and you can see China and vice versa. And China has said that it would take the island by force if the island declares its independence from China. And the U.S. policy has always been that it would defend Taiwan in such a case. Now, this earthquake that happened this week kind of put all of this military aggression to the back burner as the focus was on humanitarian rescue and recovery efforts. And Taiwan is primarily conducting most of those recovery and rescue efforts themselves. China has offered help, but Taiwan has refused it so far. The U.S. has also offered help, but in a true sign of independence, Taiwan has said, thank you for the offer, but I think we're good. Taiwan actually is very prepared. They are one of the most prepared countries when it comes to earthquakes. They have always been very prepared when it comes to emergency services on the island, and they handle the onset and the aftermath of this earthquake in very true, well-prepared Southeast Asian fashion. Taiwan, as we know, as tech investors, we know that Taiwan plays a very important role in the advanced semiconductor chip manufacturing around the world. Now, Taiwan's chip manufacturing production was disrupted because of this earthquake. As soon as this earthquake hit, manufacturers were very quick to act. They shut down all operations. They evacuated most of their fabrication plants. Some of the smaller chip producers completely evacuated and shut down operations, while some of the larger ones did continue to have some staff on site. Taiwan's semiconductor manufacturing, TSMC, is the largest and leading provider of super advanced semiconductor chips and AI GPUs, by the way, the largest supplier to companies like NVIDIA and Apple. And as of yesterday, April 4th, TSMC said they reported that more than 80% of their chip manufacturing equipment had resumed production. They'll continue to monitor the situation, but so far they have reported no damage to their production facilities, and no major disruption to their operations. As of yesterday, 80% of operations is back. And I think I saw something that as of this morning, Friday, they are back to 100% of chip manufacturing operations. So no one had an earthquake in Taiwan on their 2024 bingo card, right? I mean, I certainly didn't think we had an earthquake coming to Taiwan. Everybody has been talking about military aggression, military action, the tension between China and Taiwan and the US in the middle of all of it, and any potential military-related disruption to semiconductor manufacturing. So looks like disaster averted for now, and semiconductor manufacturing continues as we would like it to be. Let's move our attention again to another company. Let's talk about Tesla. Tesla's been in the news a lot over the past couple of weeks. There's been a lot of negative sentiment and press about Tesla, their current operations, their current profitability, a lot of negative sentiment about their forward business prospects. And even the stock has been giving out a lot of bearish signals. In fact, it has been down. It has been one of the worst performing stocks in the S&P 500 this year. Everything seems to be kind of negative Nelly about Tesla and EVs these days. I mean, there's a lot of comparison being made between Tesla and Toyota. Discussion and debate about which one has a better strategy and who will succeed in the future. Toyota is a world-class automobile manufacturer, and they consistently churn out attractive products and very solid profit margins. They continue to sell cars by the millions around the world. And we talked about what Toyota did in one of the previous episodes. Toyota has very deliberately held back on their EV manufacturing ambitions. They did an analysis that, given the amount of raw materials that are needed to produce EVs, they decided that it was in their business's best interest to produce more hybrid cars versus EVs. They also analyzed the environmental impact that the 28,000 EVs that they would be able to produce annually versus the 1-point-something million hybrid vehicles that they produce today. And they found that by sticking to producing and selling hybrid vehicles, they would make a much more positive impact on the environment while reaping the benefits in terms of top-line sales and bottom-line profits. And Tesla, as we know, took the other route, right? Tesla has been heads down focused on producing as many electric vehicles as they can. And the problem today for Tesla's investors is valuation. Does it deserve the rich valuation that it is afforded even today, even though it's dropped about 30% year to date? Today, Toyota's stock trades for just 10 times 2025 earnings, so a PE ratio of just 10, whereas Tesla's PE ratio today is at 43, so it's more than 4 times expensive as compared to Toyota. And historically, the reason for that gap in valuation between the two stocks, historically, the reason has been that Tesla has always grown faster than Toyota. But now Tesla's growth rate has decelerated. Their profit margins have shrunk. And therefore, that valuation gap is being questioned, and that is a major risk for investors. Tesla's 2024 operating margins are expected to be less than 9%, whereas Toyota's operating margins are about 12%. So Tesla's operating margins are expected to be about 30% less than those of Toyota's this year. In 2022, Tesla's operating margin hit almost 17%. And at that time, the situation was reversed. Tesla's OM was at 17% and Toyota was only at 8%. But things have flipped in the last 2 years. Now, even Tesla's 2025 growth estimates have come down. They've been reduced by about 45% over the past 12 months. And more cuts are coming as they report falling deliveries of vehicles that they are selling to the market. Now, analysts are expecting the average annual sales and earnings growth of roughly about 15% a year over the next 12 months. A few months ago, that estimate, that growth estimate was 25%. So you can see that analysts have cut their estimates by about 40 to 45% as we get more and more information about how many cars Tesla is producing as well as how many cars they're selling. Now, if you look at things over a longer time period, so looking out 5 years, Tesla's sales are expected to double over the next 5 years. And over that time frame, over those next 5 years, Toyota and Ford are expected to increase their sales only by about 20 and 10% respectively. So on a much longer time frame, Tesla is definitely expected to catch up and even pass the traditional automakers in terms of top line growth and EV sales. But in the short term, over the next 12 months or so, as we continue to deal with high interest rates, Tesla continues to hurt, their sales continue to hurt, and their margins, their operating margins and bottom line continues to hurt as compared to companies like Toyota for sure. Tesla stock has been off about somewhere around 30% year to date, and I think just looking at how the stock is performing today, that's probably up to about 35%, a 35% drop year to date. Their valuation, Tesla's valuation, has largely been based on the narrative. The Tesla mythology is that it is more than a car company, that it is a software company, it's a robotics company, it's an energy company, and it's an AI company. And they just happen to make cars as well. And so Tesla has always been afforded this rich valuation based on the mythology or based on the point of view, based on the thesis that it is more than just a car company. Just this week, Tesla reported some delivery numbers that maybe put some of that thesis at jeopardy. So this week, they reported that they had delivered just about 386,000 vehicles in the first quarter of this year. Now in Q4, in the last quarter, they delivered 100,000 more vehicles than what they delivered this quarter. So the number of vehicles they delivered, or in double quotes, sold in Q1 has dropped by about 30% over the last 3 months. That's a pretty significant drop. And this was the biggest difference between actual sales and Wall Street estimates going back 7 years, according to Bloomberg. So Wall Street had expected them to sell almost 420,000 vehicles in Q1, but they ended up selling just about 386,000 vehicles, the largest difference between consensus estimates and actual sales over the past 7 years. Their deliveries dropped 8.5% year over year, and this was the largest drop in year-over sales since the first year of the COVID pandemic. Now, despite this drop in sales, Tesla did manage to reclaim their title as the world's top seller of electric vehicles. Just a few months ago, they lost that title to China's BYD EV company, and now Tesla seemed to have gained that title back again. BYD also saw a drop in their battery electric vehicles in the first quarter. So Tesla is not alone. All the EV companies are hurting, but I think Tesla is getting much more attention because of the rich valuation that stock has typically been given by investors. So the question for investors now are, one, do you consider Tesla, do you still consider Tesla to be more than just a car company? Right, that's the first question. And depending on your answer to that question, if it's still just a car company to you, then do you need to compare their fundamentals and their forward growth prospects to other companies like Toyota? And then you make an informed investing decision. Or if your answer is that no, Tesla is more than just a car company, you know, they've got robotics and AI and software and clean energy, etc. If you think that that's your thesis for investing in Tesla, then you have to consider the future TAM for these non-automobile divisions like software, robotics, energy, and AI. And you have to factor that into your investing thesis and decide, you know, are you going to stay invested in Tesla? And perhaps the most important question for Tesla investors, and even those like me that are not Tesla investors, The most important question for us is, when will Tesla stock find a viable bottom? And will we buy into the stock at that time? A lot of investors and even Wall Street are talking about that $110 level as a magnet for the stock, and they expect the stock to bottom, to continue dropping and bottom somewhere there or close to that level. So as investors, as we get closer to that level, we'll be asking ourselves the question, do we still want to invest in Tesla, and at what valuation are we willing to put some money at risk? So what's coming up in the markets next week? It's going to be another busy week in the markets next week. On Tuesday, April 9th, we get the NFIB Small Business Index report for the month of March. The NFIB index is another leading macro indicator that I very closely follow. So I'm very curious to see how small businesses are doing did in the month of March. On Wednesday, April 10th, we get the latest CPI or Consumer Retail Inflation Report for March. And following that on Thursday, April 11th, we'll get the wholesale PPI inflation report for March. So next week, we'll get a macro update on small businesses that support 60 to 70% of the U.S. economy. And we'll get the latest inflation readings for the U.S., both retail and wholesale, for the month of March. And I will bring updates on those macro readings to you in this podcast on Friday next week. So that's all I have for this weekly episode of the Market Whispers podcast. Drop me a comment or question anytime. I always love to hear from you readers. Until we chat again, good luck in the markets. Stay healthy, stay safe, be kind to others, and take some time to do something you enjoy. After all, that's why we invest: for life, for love, and for happiness. This is Beachman signing off. Thank you and goodbye.